All right, my name is Chris Campbell. I'm a practicing CPA, and I work with small to mid-sized businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about two metrics that I take a look at when looking at the health of a business. So whether I'm looking at it in the capacity of when I'm looking through the books and going through the books, even on the higher level CFO engagements, or even when evaluating a company. That's actually an exercise I had done the other day to look at the health of a company and the potential of it to be acquired. But two metrics that I take a look at to just give me a quick overview of how healthy the company is. One is gross margin, and the other is cash flow, which is ultimately the net cash flow. So first thing is gross margin. So gross margin is essentially how much money you actually make from producing or selling in 1 year, whatever it is that you sell. So these, to quickly formulate what it is or to keep it in very simple terms, it's how much you sell something for minus specifically what it costs to make it or acquire it or whatever the case may be. So for example, if you are selling widgets, and you're selling the widgets for $6 and it costs you $3 to actually put together the widgets. I'm not talking about all the support costs, admin, overhead, things of that nature, but what it actually costs in materials, labor to actually put the widget together to sell it, that would be your cost of goods sold. You subtract that cost. So if assume that was $3, selling something for $6, and your cost to sell it was $3, then your gross margin is $3, right? Same thing if let's say you were doing resale. So if you acquired something for $8 and you sold it for $10, then your gross margin would then be $2 or say 20%. And the reason why that is a very important figure number to know is because it can really guide your thought process and guide your ability to be able to run a healthy company and grow. Because a lot of times, it's always good to save money, but I think the initial thing that you need to look at is the company making enough money initially? Which means, is the company, and this is fundamental, but is the company making enough money on every product that they're selling? And the issue is that if the company is not making enough money on the product that they're selling, and it's very difficult to scale, have a healthy business when you're simply just not making enough money on any initial products that you're selling. So that's why it's very important. So before you look at any other overhead, try to cut this cost and cut that cost, the question is, are you making enough money on what you're initially selling? So what you can do is to get an idea if that is the case is just use benchmark. So it's easy to look it up and say, okay, I'm selling this, or I'm in the business of providing XYZ service. What are the benchmark gross margins, and compare those to what it is that you're doing. So if you feel like you're performing below those standards, then a couple of things that you'll either have to do is to raise your prices to get within standard, or is it that you're possibly paying too much to produce what you're selling? So that's something that's very important to consider and take a look at. So that's why it's a very important measure as the gross margin. So that's one. And then the other is cash flow, which is quite different from net income. So most of the time you may go look and see, okay, well, how profitable is the company? And you may go look at the income statement, see, okay, well, there's profits coming in, things are bad. But sometimes that only tells part of the story. So what I also like to do is take a look at a cash flow statement, because I'll give you two examples of when a company can look healthy as far as profit wise, but may have a profit growing. If a lot of the sales that you're recording are what you're using the accrual basis, meaning that you billed for it and you recorded it as revenue or sales, that you haven't collected the money in, and you're having issues collecting the money. So if you're on a accrual basis, you're going to show that money as revenue, and it'll count as income. But if you haven't received the cash in, and you may have issues collecting the cash, then it's very difficult to grow a company without cash, right? And your cash flow is going to answer that for you. And I just want to point that out. by looking at what's called the statement of cash flow. So that's how you determine what your cash flow is. So that's why that's very important, where net income can be deceiving. And then the other thing is, and I see this a lot with very closely held companies, where the owner may be taking too much out of the company. So yes, the profits will be there, but if the owner is taking out excessive amounts and not providing enough capital for the business to grow, then that also creates an issue for a company to scale, right? So, I see that commonly in, let's say, S corporations, LLCs, where the owner doesn't necessarily take salary, or they take a smaller salary and then they take the remaining in distribution. So it happens a lot in S corps, where maybe like one or two owners, where the wages may be relatively small, but it doesn't necessarily cover in full. They may take their salaries, and the salaries may be nominal or minimal, but they may also be taking 2 or 3 times that in distributions. And the thing is, that doesn't show up on the income statement. But again, we're easily able to pick that up in a statement of cash flow. So that's why it's very important to make sure that you're also taking a look at the cash flow if it's a part of the business. That statement of cash flows can be very telling as far as letting you know how healthy a business is, because at the end of the day, you're going to need cash. In order to make some things happen, grow and scale, you need cash. So if the cash is not there, you're going to have problems to look at. So understand that those are 2 things that you may take a look at yourself. You want to and check to see if the company is healthy or not. Take a look at those margins, and then also take a look at cash flows, right? Because it will ultimately tell you how much cash is coming in or out of the business. So if you are looking at your statement of cash flows and see constant overall outflows of the business, then that shows that it's a relatively unhealthy business. You want constant inflows. So when you're looking at your statement, make sure it's reflected as such. All right. So I don't want to get into a whole tutorial. Maybe that'll be for another video. So just in general, I'll say that. So keep track of those 2 things. You can kind of get a quick idea of how healthy your business is, or your business that you're looking at. So keep those things in mind. So that's all for now. Hopefully this was helpful. And if you have any more questions about this topic or any other tax or account related issues, feel free to reach out. I'm happy to help. All right. So that's all for now, and I'll talk to you next week.